Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Nilesh Shah, MD and CEO at Envision Capital, joining in. Welcome to the show, Nilesh, and always a pleasure to speak to you and wishing you a happy Diwali and all the viewers as well.
Thank you, Hiral, and wishing you a very happy Diwali and a prosperous New Year to you, your family, and to all the viewers and their families as well.
Thank you so much. Nilesh, my first question coming to you is last couple of Diwalis, though the mood has been slightly grim because of COVID, but this year you're seeing a lot of pent up enthusiasm that is actually bouncing back. How would you compare the Diwali for markets this year versus the last 2 to 3 years?
Well, in terms of the general environment and the sentiment, this time around, I'd probably say that the sentiment is a lot more positive. There are pretty much less number of worries in terms of people are not as concerned about the way they were last year or the year before that in terms of the health and COVID and mobility and movement and all of that. So to that extent, I clearly see this time around consumers in general are wanting to kind of in a way step out, have the experiences, are indulging, and all of that. So on the whole, this Diwali is looking to be a lot more positive and a lot more buoyant than what the previous Diwali, the last two Diwalis have been.
Right. So, Nilesh, overall, from a market perspective, let's break it up between international as well as domestic. This is the time for festivities, specifically in the domestic market. The mood in terms of international markets is grim right now. People are talking of a recession coming in the UK as well as if you talk about the US. Plus, you have political uncertainty as well in a couple of countries. Over and above that, you have warlike situations which are already ongoing between Ukraine as well as Russia. And you have a downtick coming in with regards to China. Taking all of these situations globally into consideration, firstly, how would you actually place and look at India as a country? And secondly, where would you place it from an investment perspective?
So clearly, we all in India are this time around a lot more fortunate. Like some of the other big nations that we talked about, be it United States, United Kingdom, China, Russia, they all have some challenge or the other, be it economic growth, be it inflation, be it political stability or instability, geopolitical issues, all of that. Versus that, here we at least are having a steady economic growth of broadly around 7%. Inflation is, yes, it's 7% plus, but it's a lot lower than the inflation that we are seeing in some of the developed economies. And of course, on political stability, we seem to be having political stability, which we've not enjoyed for like decades. So I think on the whole, India is a lot more favorably positioned and placed versus the rest of the world. And I would probably use this occasion to just kind of take a saying which the IMF just kind of in a way had last week when they had a review, where of course they have downgraded the growth forecast for the entire world, including India. But it was very heartening when IMF said that India is a bright spot in an otherwise darker horizon. I really think that call out by IMF pretty much sums up how India is today placed and positioned in an otherwise globally challenged environment.
Right. So with this said and done, if you have to look at investments in India, a couple of things which are working in our favor as well as in terms of the macros that you already mentioned. FIIs are coming back as well, and there is some bit of stability on that front. And the DIIs have also started picking up pace. How would you actually view this entire scenario?
This is a very, very interesting kind of a trend, which is really we've seen, over the last 12 months, where the FPIs or the FIs have been continuous sellers. And domestic institutions as well as retail investors have been continuous buyers. And this as a trend to me is not just the trend now for the last 1 year, but I see the trend of domestic institutions and retail investors continuing to kind of participate in India's growth story through equities, be it through mutual funds, be it through PMSs, AIFs, or even direct investments, for now, just not a few years, but for maybe the next several decades. for the first time, I think after a very long time, the ownership by domestic institutions is kind of higher than ownership by foreign institutions. And this, I think, is very heartening. And to some extent, it reduces the volatility of the Indian markets. And that's what we've experienced in the last 1 year. The positive thing is that when risk on comes back, when the US Fed and the other central banks are done with rate hikes and they have, in a way, quelled and conquered inflation, you would again see these FPS come back and buy into India with a bang. And just kind of imagine that when that happens, what's the kind of upside potential that it could create, for Indian equities. So on the whole, I see this as a trend which has started over the last 12 months, but I expect this trend to sustain over the next several years and perhaps over the next several decades. So I'm actually very positive with the kind of participation that is really coming from domestic investors, especially retail investors. That's acted as a huge margin of safety and a huge cushion for Indian equities versus the rest of the world.
Right. So Nilesh, this is always a question that everyone asks and everyone thinks, as to what should be the next milestone for Nifty and Sensex then?
I have to give these kind of numbers, but these milestones would not have much of a relevance. The reality is that we're probably currently trading at about, on the Nifty, we're at 17,500, 18,500 was the high in 2021. I probably think that sometime, during the course of the coming Samvat, we should be able to cross 18,500 and make a new high. And I don't see this stopping. The reality is that our corporate earnings to GDP have bounced off from probably a 20-30 year low. And if the economy were to grow at 6-7%, inflation is at 6-7%, add to that a 13 to 14% nominal GDP growth, and if corporate earnings on the back of that can grow at 15-20%, I think that's a great situation to be in. And therefore, it's quite possible that our Nifty or our senses also, in a way, reflect this growth in corporate earnings. And therefore, their values also basically go up in a proportionate manner. So I would probably think that Nifty and Sensex can compound or grow in double digits, maybe between 12 to 18% as a range, maybe over the next 3 to 5 years. And if that will be the case, both these indices could, over the next 3 to 5 years, be 50 to 75% higher compared to where they are today.
Right. And overall, from an investment perspective right now, there is a little bit of fear that still comes in, whether is this the right time to buy or not. And the best advice that everyone is giving is that this is probably the best time to start accumulating. So if this is the strategy, if you have to adopt, what are the sectors that you would advise?
Well, there are a whole bunch of sectors which are doing extremely well. We're in the midst of the current earnings season, and clearly even during the course of this earnings season, we continue to see continued buoyancy in several sectors. But what I think over the next 3 to 5 years, some of the sectors which will do extremely well could be financials. Clearly, financials continue to be the bedrock for any economy. And therefore, clearly, financials are expected to do well. Our banking system has just come out from a very long period of asset quality challenges. These problems are behind them, and they are now poised for very strong growth. So I think financials is a great place to be in. The other big opportunity that I see is manufacturing. Manufacturing of chemicals, manufacturing of pharmaceuticals, manufacturing of textiles, manufacturing of defense products. These are all, again, big opportunities that we have in front of us. And this as a space is enjoying the tailwinds of PLI, of GST, of bankruptcy code, lower interest rates, some of the labor reforms, all of these, plus, of course, the China Plus strategy. So clearly, manufacturing as a space, I think, is a huge opportunity. And the third area which I see is technology-led businesses. I think a lot of technology-led businesses, be it B2C businesses, B2B businesses, I think are poised for interesting times. Clearly online brokerages, online insurance companies, our conventional IT services companies, all of these kind of are very, very interesting medium to long-term investment opportunities.
Right. An interesting point you brought up, Nilesh, in the conversation right now is with regards to technology stocks. Simultaneously, the thought is right now that with taking the global scenario into consideration, it's best to avoid export-oriented sectors. So specifically when you talk about IT as well as pharma. However, IT always has been one of the safe bets. So, would it be right to say that IT as an investment bet will not be a growth oriented sector right away, but more of a safe haven?
Uh, I'm not too sure about the safety level, but what I probably think our understanding or our analysis is
Hmm.
that the year 2022 has been honestly a very, very difficult year for IT stocks. Most of these IT stocks have corrected between 25% to 50%. And that's because there are concerns in terms of whether the growth will sustain, whether margins will sustain. I clearly believe that both growth and margins are beginning to normalize. And therefore, I think is that broadly, IT as a sector could basically again witness around a 15% annualized growth. There will be some businesses which will probably grow below 15%, and there'll be some companies which will grow north of 15%. But on a aggregate basis, IT as a sector can grow at about 15%. My view is that the downside could still probably persist for maybe another 1 to 2 quarters, because I think you're going to see a lot of data come out from the United States, and it's expected that in the calendar year 2023, the United States economy is likely to step into a recession. And I think when that happens is when IT stocks could potentially bottom out by then. So I probably think that IT continues to be a buy on dips sector, and maybe sometime in the early part of 2023 or the first half of 2023 is when they could potentially bottom out. And from there onwards, maybe between mid 2023 to maybe sometime in 2025, over the course of next 2 3 years, it could end up being again a market outperforming, or a pretty much a rewarding sector from an investor's point of view.
Right. So, with that said and done, you mentioned about manufacturing as well. Now, between defense and again, if you see on the cap goods side, where would your bets be? Because clearly, with cap goods, what's happening is a lot of investments are getting into play, a lot of spends happening from the government area, and the private probably is picking up as well. Whereas defense as a sector is something which is now evolving over time. So, between the two as well, where would your bets be?
I would probably think that both look very interesting. Just that the cap goods space surely I think is likely to do well for at least a couple of years from now, because obviously the manufacturing, industrial, infrastructure, mining, these are some of the sectors which are going to do well. There's going to be a need for a lot of capital equipment, a lot of products out there, and a lot of capacity is going to be set up. And if the economy, if we continue to grow at 6-7%, capacity utilization will kind of keep inching up over the next 1 or 2 years, and therefore companies are going to go ahead and make investments. So I think the capex opportunity is surely there for the next 2 to 3 years. It's hard to kind of say really beyond that how is going to be the entire capex space going to shape up. Versus that, the defense sector is an opportunity just not for the next 2 years, but it's probably an opportunity for maybe the next 1 decade or maybe even for the next 2 decades, because there are some really strong structural tailwinds going for the defense sector. The whole geopolitical environment globally, I think if we look at it that, I think if we look at India's national security requirements, if we kind of look at the government's Atmanirbhar program, the self-reliance program, the indigenization plan, and then of course the eventual plan to even export defense goods on the whole, therefore, I think there is an incredible opportunity for some of our defense PSUs as well as for some of the private sector defense companies to grow for the next maybe 3 years, 5 years, 10 years, or maybe even beyond. Defense is an opportunity could probably be where the road construction opportunity was maybe 10-20 years back, or where the IT services opportunity was 20-30 years back. So I probably think that defense is clearly a multi-year, multi-decadal opportunity.
Right. And apart from that, so what are the kind of stocks that you would be holding from a defense and a cap goods perspective right now?
What we own currently in our PMSs for the defense sector essentially are BDL, Bharat Dynamics, and GRSC, Garden Reach Shipbuilding. These two companies. I mean, BDL is a specialized missiles manufacturer, and GRSC is a builder of naval ships. So these are the two companies that we own, and we're evaluating a bunch of other defense PSUs as well as some of the private sector companies. On the capex side, what we have been owning is a company called Hitachi Energy, where we have, of course, trimmed down a position a bit over the last few months as there has been a strong appreciation. KSB Pumps is again is something which we have been owning and we still like it. CG Power again is a capex play that we have owned now for some time, but we have just recently exited, given that the valuations now have turned pretty much on the higher side. But if the stock price correction or if the valuations become more comfortable, we'll be happy to kind of come back. So these are some of the picks that we've had on the capex side and some of the picks on the defense side.
Right. And apart from these sectors, Nilesh, if you have to look at FMCG or the consumption side of it, as we started the conversation as well, the story looks pretty strong in terms of where India as a domestic market is concerned. A lot of factors which are aiding the FMCG space as well. When you talk about, say, palm oil prices are going down. So commodities overall, that's something which is aiding the FMCG pack. What would your view be specifically with regards to FMCG as well as consumption, and any picks on that front?
So we like the entire consumption space. Again, we think that consumer as a space essentially is again a very, very long-term structural opportunity. And I completely agree with you that going forward, this sector has faced the brunt on the margin side because of higher raw material prices, especially some of the food product companies, the packaged food companies. They have been impacted quite a lot because of spike in palm oil prices and all of that. But we think that those problems are now behind them. And going forward, we actually believe that some of these companies have taken price packs, they have altered their packaging, they have brought in other cost efficiencies, and above all of that, palm oil prices and some of those other raw material prices have peaked off. So we actually like this space. We own companies like Zydus Wellness, Mrs. Bector's Foods, Pratap Snacks in our PMSs. And then this is essentially the bunch or the segment that we like the most in the entire consumer space, companies which are focused on food, health, and wellness. So that, and we have some of our positions also that, and we are incredibly positive on this segment, and we like it from a medium-term perspective.
Right. And my last question, Nilesh, coming to you is, again, between large caps and mid caps, if this is the time to invest, would it be good to start looking at the large caps and keep a hold on mid caps, or do you think a combination of both is going to do well right now?
I think there's room for both. Clearly, India is in a virtuous growth cycle right now and is expected to remain so for many years and many decades. I clearly believe that this is going to be a market for bottom-up investors who can do their fundamental research and pick high-quality stocks across the spectrum of large caps, mid caps, and small caps. So I think it's good to kind of, in a way, have an all-cap or a multi-cap kind of a strategy. But it looks like is that the way the economy is poised, the mid to small caps can obviously kind of outperform quite significantly over the medium term. So if you have the wherewithal, it's always a great place. Mid caps and small caps are always a great place to be. But I think there is room even opportunistically for some of the large caps as well. So I think on the whole, I would think that there is opportunity across the spectrum of capitalization.
Absolutely. And I think right now the position and the situation that we are in as well, we can't say it's 100% a sweet spot, but a much better spot versus other economies and what everyone is going through. So with God's grace, that's a good Diwali for everyone as well. Thank you, Nilesh, so much for speaking to us. Stay safe and wish you again a happy Diwali. Speak to you soon again.
Thank you so much, Shirul. It was a pleasure being on this show. And once again, festive greetings, Diwali wishes, and New Year wishes to you, your family, and all the viewers. Thank you so much.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.